3 concepts investors must know about Bitcoin's 4-year cycles. Bitcoin's 4-year cycle is a crucial concept for investors looking to understand its market dynamics. Driven by a unique process called the halving, these cycles create periods of both growth and volatility. Here are the top 3 things to know. The Bitcoin halving supply shock. Bitcoin's halving is unlike any event in traditional finance and plays a vital role in shaping its price. Roughly every 4 years, the reward for mining Bitcoin is cut in half. This effectively reduces the rate at which new Bitcoins are introduced into the market, leading to a supply shock. Combined with Bitcoin's capped supply of 21 million coins, this predictable supply reduction can significantly affect price dynamics. Prior to the halving, the supply and demand are in relative equilibrium. Demand coming from settlement, approximately $40 billion per day currently, and accumulation are in balance with the existing supply stock and new issuance of Bitcoin each block. However, when the halving occurs, this equilibrium is disrupted, spurring renewed speculative interest and driving new cycles of price discovery. A halving event is not tied to a set date, but instead a block height or block number. With each block aiming to be mined every 10 minutes, the halving occurs every 210,000 blocks, or approximately every 4 years. Currently, block times average about 9 minutes and 42 seconds due to fluctuations in the network's computational power, meaning the interval between halvings is slightly shorter than 4 years. The supply shock triggered by the halving has a significant impact on Bitcoin's price behavior. While the halving itself is a well-known event, priced into a degree prior to occurring, the full price effects typically unfold in stages. It is impossible to price in unknown factors like investors' personal reactions to significant price levels, decisions by large pools of capital that can significantly move price, or market fears, especially the fear of missing out. Number 2. Anatomy of Bitcoin boom and bust cycles. Bitcoin's halving-induced supply shock set the stage for a boom and bust cycle that has been a recurring pattern in its history. This cycle is largely driven by how supply scarcity interacts with speculative demand, leading to sharp price increases, the boom, followed by overvaluation and eventual correction, the bust, before settling into a new equilibrium. Bull market formation. The halving is a one-sided force that almost universally leads to upward pressure on price. It is difficult to imagine a scenario where a reduction in supply, while demand remains steady or increases, is interpreted negatively by the market. Existing sources of demand, such as Bitcoin's use in settlements and accumulation by both retail and institutional investors, remain unaffected. At the same time, the halving logically leads to more demand from marginal sources as investors anticipate future scarcity and speculate on higher prices. As this supply-side pressure builds, the early stages of a boom are marked by steady price appreciation, gaining momentum as more market participants take notice. Retail investors, driven by the FOMO, further accelerate the price increases. With each new price high, Bitcoin draws more attention, leading to institutional involvement and additional buying pressure. At this stage, Bitcoin's narrative as a hedge against macroeconomic uncertainty or inflation can also boost its appeal, attracting even more demand. Bear market formation. Like all markets, Bitcoin's bull markets eventually reach a peak. In the later stages of the boom, early investors begin to take profits, and the pool of new buyers shrinks as they become fully invested. Prices can spike rapidly during this phase, driven by speculative mania and short-term exuberance. This euphoria typically culminates in a blow-off top before the market begins to correct. As the top forms, marginal buyers disappear, and those who bought at or near the top often panic sell, accelerating the downturn. The initial drop can be swift and severe, as the market adjusts from overvaluation. Historically, Bitcoin's bear markets have retraced in each cycle to a higher floor, leading to successively higher lows, showing the progressively higher market equilibrium. This is due to the dramatic returns achieved during the bull market phase. While market tops are typically overvalued, bottoms are often undervalued, and a new equilibrium forms after prices stabilize and speculative excesses are flushed out. The market eventually seeks a new equilibrium where price more accurately reflects underlying supply-demand fundamentals. This bust phase can last anywhere from several months to a few years, as the market digests the speculative froth. Once this excess is cleared, the Bitcoin market begins laying the groundwork for the next cycle. As supply-demand dynamics stabilize, new investors gradually return, setting the stage for the next halving to repeat the process. Number 3. The importance of time preference. Time preference refers to how much an individual values present consumption versus future rewards. A high time preference favors immediate gains, while a low time preference prioritizes long-term benefits and patience. In Bitcoin investing, having a low time preference is crucial due to the cyclical nature of its price movements, driven by halving events. Short-term volatility can be misleading, making it essential to focus on Bitcoin's long-term potential. A low time preference encourages individuals to focus on the larger picture, Bitcoin's properties and historical trends within a deteriorating macroeconomic environment. This approach is why many experienced investors favor strategies like dollar-cost averaging, where purchases spread out over time, regardless of the price. Rather than trying to time the market, these investors commit to holding Bitcoin for several years, often 5 or more. By maintaining a low time preference, they are better positioned to ride out the volatility. Bitcoin is the only asset with a strictly fixed supply. This property alone dictates that in the long run, as fiat currencies lose value over time, Bitcoin's value will rise in nominal terms and be more stable than other assets in real terms. Investors with patience, those who focus on wealth preservation rather than quick profits, are more likely to reap the rewards of this hard money asset. By committing to a multi-year time horizon, investors can avoid the pitfalls of market timing and benefit from Bitcoin's cyclical growth. This post originally appeared on Forbes' digital asset page. The link is in the description. You can find more of my work there and on bitcoinandmarkets.com. I hope this helps someone. Please like, subscribe and share for more hard-hitting Bitcoin and macro content.